Hi, friends. This is Colin Richards, president and founder of Lord and Richards. And once again, I'm excited to be with you today here on Lord and Richards Radio. And I'm going to be talking to you today on the subject of staying too long at the ball, a little three-part series. We're going to discuss the impact of the markets on your dreams, your goals, your values. And one of the key principles that we have embedded in our culture of investment at Lord & Richards comes from the Word of God. It comes from the book of Proverbs, chapter 13, verse 11. And it says, "Wealth gained hastily will dwindle, but whoever gathers little by little will increase it." That is a powerful principle. As a matter of fact, most of us have probably taught this to our children or to the next generation, saying, don't fall for get-rich-quick schemes. And I want you to understand that we view the market as a place of tremendous opportunity for investors. Whether you follow biblical principles or not, though, the Bible gives some timely warnings about the wrong way to invest, even in places like the market. And when we talked about gaining wealth quickly, dwindling, that means that basically we are falling for get-rich-quick scheme of a different order. It is by taking the prevailing advice, we may well be following the stream as it flows down towards an eventual waterfall. And we want to avoid disaster. We want to avoid collapse, especially as we are in or nearing our retirement years. This is not the time for us to make catastrophic mistakes. And the market has been shown over and over again to catch investors off guard. Oftentimes, there are warning signs, there are signals, and we're going to talk about that today and why you need to have a strategy in order to buffer yourself against the risk of a catastrophic market decline. But coming back to that biblical principle, it says wealth gained quickly or hastily will dwindle. By that, I'm suggesting when we bet the farm in order to try to increase our upside, we are setting ourselves up for dwindling wealth. We are setting ourselves up for potential disaster. The best investors in the world know this and don't do this, okay? I regularly espouse and even hand out to those that I meet with every day a book from Morgan Housel, a behavioral psychologist, called The Psychology of Money. And as a behavioral psychologist, he doesn't just put forth a dry textbook. He actually enriches your mind with stories of past investors that have been successful, as well as those who've been dramatic failures. And the key difference generally has to do with the approach to risk. Some may be overly cautious, some may be overly aggressive. You say, well, Colin, is the solution to sit in the middle and be a moderate investor? I'm going to suggest to you that that's poor advice, because usually what happens is you wind up with a portfolio that's sort of a blah blend right in the middle with not too much growth opportunity, maybe not quite as much risk, and you're just blahing along. Well, our models, our software, our projections show that that's actually damaging and harmful to your retirement future. Some refer to this as the 60-40 stock bond portfolio, a portfolio that investment advisors have just thrown together on the assumption that by having kind of a growth component in stocks and a so-called safety component in bonds, you can avoid both the catastrophic falls of the market, but you're also going to avoid really the great gain potential of the market. I would suggest to you, and economists are on my side, that the 60-40 portfolio approach is dead. And here's the reality. Most of the people I'm talking to right now are in that kind of portfolio. Oh, it might be 50-50, it might be 40-60 and so forth, but your typical advice is leading you down the wrong path. You say, well, it's worked so far. Well, folks, let me remind you that in the middle of bull markets, everything looks rosy, right? Back in the 90s, if you could fog a mirror, you could make money until you couldn't when the year 2000 dot-com collapse occurred. Same thing running up to 2008, 2009. People were euphoric. They were enthusiastic. So the Bible actually suggests gathering little by little. Does that mean, well, Colin, we should just be in conservative investments that never have any exposure to risk? I'm not suggesting that either. What I'm suggesting is a different approach whereby you gather in a more aggressive way on one side of your portfolio, and on the other side, you are more conservative and protected. This strategy of kind of separating out into different segments of your portfolio, risk and growth together with protection and growth, is called the barbell. And I talk about it all the time, and I borrowed it from our friend Morgan Housel, who wrote the book Psychology of Money. And he suggests that that's his own approach, that the greatest and most successful investors consistently will go for opportunities, understanding the risks that are involved, taking a calculated risk, just like a business owner might, but not betting the farm. You say, well, why doesn't the stock bond mixture, the 60-40 portfolio, solve that problem? Don't bonds always move the opposite direction of stocks, giving me that protection? It's unfortunately not true. Take the most recent severe market drop in 2022. Stock markets lost in excess of 20%, making it a bear market, one that happens regularly, by the way. It happens every 7 years. It's not like clockwork, but that's the average. Well, in that most recent 22 bear market, we saw bonds drop just as much as stocks because there was so much going on in the economy. Same thing in 2008, 2009. Almost every asset class is dropping simultaneously. So you say, okay, if there's still opportunity in stocks, and that's exactly what I'm saying, then how do I provide safety on the other side? Well, that's going to be in the form of alternative strategies, alternative investments, not doing the same thing and expecting different results. We call that the definition of insanity. And so, folks, I want us to learn how to gather little by little by having safety and opportunity on the same dollar at the same time, as well as other more aggressive opportunities elsewhere. And so we're going to have that kind of mixture. In our next segment, I'm going to talk to you a little bit about some of the warning signals that we're facing. Today, we're talking about the area of risk management, which is a key differentiator and a specialty of my team. At Lord & Richards, we believe that risk should be managed as a steward, not an owner. As recipients of God's grace, we want to manage the risk knowing that we're really taking this risk on behalf of God with our portfolio. And so what are the cautions that not only the Word of God, but even current events are telling us about the market? In spite of wars, in spite of the threat of geopolitical instability, despite the constant political wrangling, despite the threat to our oil supply, and on and on and on it goes, there are some actual data points you and I can look at, and they may not be the ones you're worried about, right? At the gas pump, you're worried about, am I paying too much for gas, right? And what can the world do to my gas? Well, we're actually looking at the market today, and what are the key indicators that indicate whether or not we have some danger that's building up. By many historical metrics, the U.S. stock market is currently overvalued and sits at near or actual all-time highs. And so the question is, should we be concerned about that, right? If companies are doing great, isn't that a wonderful thing? Right? A majority of S&P 500 companies have been generating strong profits recently, strong margins as well. That means the difference between their costs and their revenue. Massive investments in and future earnings potential from artificial intelligence have driven up the valuations of multiple tech companies, including the Magnificent Seven technologies. The overvaluation may be tied to a small dominant group of cash-rich tech companies, meaning that the broader index might not be as frothy as the top-heavy headline numbers suggest. So those are all reasons maybe to justify what's going on in the markets. But let me give you a note of caution, and then we're going to talk about how to deal with this, okay? But let me just help you by expressing to you what we're doing for clients just like you every single day who are looking to retire or stay retired. What we do is we help you incorporate values like the ones I'm sharing, like managing risk as a steward, not as an owner. We incorporate those values into our planning so that you get what is called a retirement freedom review. That's an opportunity to sit down, let us have a wonderful conversation, a cup of coffee together, get to know each other, and then let us study your portfolio and share with you what your likelihood of achieving your goals and dreams are. Very often we discover there's room for improvement because most of us have been in portfolios designed to take advantage of only one direction of the market, and that is up. We can show you how to protect yourself during down markets and still take advantage of up markets. It's called a Retirement Freedom Review, and it's complimentary, and I would love to talk to you about it. It simply starts with a phone call.